Hello, this is Rich Dad. As soon as October began, Powell kicked things off with his speech about further rate cuts. Despite this, Bitcoin took a hit right from the start. Even though Bitcoin has dipped a bit, I still remain optimistic about the market. The oldest and most renowned major bank in the US, which is also globally recognized, is entering the market. And the financial market data and on-chain indicators in the US are gradually providing evidence for a bullish trend. In today's video, I'll break this down step by step. Let's begin. There were two significant issues that could have impacted the market yesterday. The employment data and the Iran-Israel conflict were the two issues. Let's discuss the employment data first. The JOLTS report is a monthly job openings and labor turnover statistics report released by the U.S. Bureau of Labor Statistics. It plays an essential role in understanding the demand and supply conditions in the U.S. labor market. The strong employment data seems to have led the market to react negatively to the possibility of interest rate cuts. The data shows trends in job postings, new hires, and job separations, resignations, or layoffs across various industries as of August. Compared to 2023, the figures for job postings, new hires, and total separations have decreased. Although job postings have declined, the ratios of new hires and separations indicate that the market is still perceived as resilient. Therefore, the market seems to have anticipated a negative impact on interest rate cuts due to these conditions. And regarding the Iran-Israel war issue, the fighting has been ongoing even while Bitcoin was rising throughout September, so it's not as if they suddenly started fighting after a period of calm. I don't think we can say that the additional missile launches were the reason for the decline. However, it would be inaccurate to say that they had no impact on the market's further drop. Let's take a look at the chart. This is the daily chart for Bitcoin. The areas I marked with arrows indicate the beginning of the first week of July, August, September, and October. For the past 4 months, each new month has started with a decline. After that, there has been a recurring pattern of recovery movements. From the low on September 6th, Bitcoin rose about 26% to 66.5K, indicating it was time for a correction. At that time, with employment data and the war issue in play, it added more weight to the possibility of a decline. However, it is still within an upward channel, so I don't think we should assume that this decline indicates a bear market, even if it were to drop further from here. As long as it doesn't break the low from September, there's significant volatility, but it continues to make higher lows and higher highs, suggesting that the upward trend is still intact. October has historically seen Bitcoin rise, with only 2 exceptions in the past 11 years, so there are high expectations for another increase this year. Although Bitcoin dipped as October began, it seems more likely to foster optimism than worry, notably in 2016 and 2020, which coincided with the US elections. Bitcoin rose by 100%, and this year, there's only about a month left until the elections. Hoping for similar results this year, I will continue the discussion. According to Bloomberg, the world's largest custody bank, BNY Mellon, has announced plans to provide custody services for spot hash Bitcoin ETF funds. The launch of BNY Mellon's cryptocurrency ETF custody services can be seen as a more significant event than the provision of cryptocurrency services by traditional financial institutions. This is because BNY Mellon, as the world's largest custody bank, can provide substantial trust in the cryptocurrency market rather than being just a regular financial institution. Let me first explain what custody services are. Custody services can be understood as a service that securely holds your assets on your behalf. This service is primarily used by those who deal with large sums of money or need a safe way to store their assets, especially for high-risk assets like cryptocurrencies that are vulnerable to hacking. Simply put, it acts like a bank vault. Just as I entrust valuable items to a bank vault, it securely stores digital assets like cryptocurrencies. So, what is the most important factor when trying to store my precious assets? It is undoubtedly how safe my assets are when stored. Mt. Gox, Bitfinex, Binance, KuCoin, and many other exchanges have not been safe from hacking. Moreover, individual wallets are similarly vulnerable. As a result, the need for securely storing cryptocurrencies has become increasingly prominent, leading to the continuous emergence of cryptocurrency custody services. To add more information about BNY Mellon, it was established in 1784 and is one of the oldest financial institutions in the United States. It provides large-scale asset management and custody services, primarily targeting financial institutions, corporations, and government agencies around the world for asset custody, investment management, and financial services. While it also offers financial services for high-net-worth individuals, such as asset management and trust services, general retail banking services are not its primary business. Its main clientele consists of large asset management firms, pension funds, insurance companies, companies and hedge funds, with large-scale institutions that need to manage or safeguard vast assets as primary customers. This underscores that BNY Mellon is a financial institution with significant influence not only in the United States, but also globally. Therefore, BNY Mellon's Bitcoin ETF custody service holds significant meaning, and it is likely that other financial institutions will gradually begin to offer custody services as well. This would enable investors to invest in cryptocurrencies with greater confidence. For the cryptocurrency market to achieve explosive growth, the issue of trust must be addressed. Since this is an important aspect, let's take a closer look at it. Since cryptocurrencies have no physical entity and exist entirely as digital assets, there are significant concerns regarding asset loss due to hacking, fraud, and technical errors. For example, in the Mt. Gox exchange hacking incident in 2014, which was a major issue until recently, approximately 850,000 bitcoins were stolen from the exchange, which accounted for 70% of all Bitcoin transactions at that time. As a result, many investors incurred substantial losses, leading to increased distrust in the cryptocurrency market. Bitcoin and the cryptocurrency market are intangible assets, right? While they exist as numerical values in digital form and cannot be physically touched, just as electronic commerce requires systems to securely protect credit card information, cryptocurrencies also need an infrastructure based on security and trust. Without reliable custody services, no one would trust their assets to be held. Cryptocurrencies are often associated with negative perceptions due to their anonymity and decentralized nature, which makes them frequently used for illegal activities, particularly because they can be used for activities such as money laundering, terrorist financing, and tax evasion. Regulatory agencies and governments often harbor distrust towards cryptocurrencies. If cryptocurrency projects are not operated more transparently and in compliance with regulations, these negative perceptions are likely to continue to grow. Building trust is essential for the cryptocurrency market to integrate with institutional finance. Regulatory compliance and reliability are key factors for traditional financial institutions and institutional investors to start handling cryptocurrencies. For example, if large banks like BNY Mellon mentioned earlier offer services to custody or manage cryptocurrencies, this would allow institutional investors to enter the cryptocurrency market with confidence. Cryptocurrencies exhibit extreme price volatility. When there is a lack of investor confidence, price volatility can worsen. A lack of trust can trigger large-scale sell-offs or incite market fear, which can destabilize the entire market. Conversely, when trust is established, investors are more likely to invest in cryptocurrencies for the long term, leading to improved market stability. When the cryptocurrency exchange FTX collapsed, the cryptocurrency market took a significant hit and investor confidence plummeted. As a result, the prices of major cryptocurrencies, including Bitcoin, fell sharply. This incident serves as a prime example of how the market can react when trust is eroded. This is why the issue of trust is an extremely critical factor in the cryptocurrency market. Although the number of people investing in Bitcoin and cryptocurrencies has significantly increased just looking around, you can see that there are still many people who do not trust it at all, and that alone indicates that there are far more individuals who remain disinterested. Therefore, if the issue of trust is resolved, cryptocurrencies will be much more widely accepted, and I believe that a significantly higher number of investors and institutions will enter this market. Thus, strengthening trust can be seen as an essential prerequisite for the growth of the cryptocurrency market. Therefore, when BNY Mellon's Bitcoin ETF custody service is implemented, it will create a much more trustworthy foundation for investors, and it could serve as a catalyst for more banks to enter the market. This can be seen as a significant positive development for the Bitcoin and crypto market. At this point, I would appreciate it if you could hit the subscribe and like buttons. It only takes a second, so please do it once. Now, I will discuss the content of Powell's speech from this week and present facts regarding the current economic data in the US one by one. The article you are looking at is from Bloomberg. On October 1st, Powell took the microphone. In this speech, he focused on the issue of future interest rate cuts. Powell and the Fed stated that they would lower interest rates over time and emphasized that the U.S. economy would maintain a solid foundation. The fact that they plan to continuously lower interest rates indicates that liquidity will continue to be supplied to the market, so it should be viewed positively. The Federal Reserve does not feel an urgent need to cut interest rates at this time and stated that any decision on rate cuts will depend on economic data. They added that if the economy slows more than expected, they could lower rates more quickly. I believe these statements are related to the labor market conditions discussed below. Currently, while the labor market is said to be robust, it has cooled over the past year. This means that the pace of job growth is slowing and employment conditions are not as vigorous as they used to be. However, the figures are still insufficient to curb inflation, suggesting that it may invest to some that further cooling might be necessary. In summary, it is judged that the labor market has sufficiently cooled. Additionally, as U.S. inflation approaches its target, it is influencing the possibility of interest rate cuts. The black line represents the U.S. core PCE price index, while the yellow line shows the annual inflation rate changes over the past 3 months. If you look at the yellow line, it indicates that inflation is gradually approaching the Federal Reserve's target of 2%. The decline in inflation suggests that further interest rate cuts may be possible. This chart illustrates the relationship between gross national income, GNI, and gross domestic product, GDP. Recently, the slight decline in gross national income has indicated a narrowing gap between the two indicators. In simpler terms, the income of the U.S. economy has been revised upward more than expected, suggesting that the economy has strong resilience. In addition, U.S. real estate prices are rising again. An increase in real estate prices can generally signal that the economy is operating actively. When people earn more money or have more disposable income to invest, they tend to buy houses or commercial properties, driving up real estate prices. However, if prices rise too much, problems can arise. This could negatively impact interest rate cuts, and if home prices become too expensive, people may not be able to buy houses, which might reduce their spending on other goods. Ultimately, this could lead to a decrease in consumption, potentially resulting in an economic recession. Currently, commercial real estate prices are 19% lower compared to the peak in 2022. So even if prices rise, they are still at a stable level after having significantly decreased from the peak. Now let's take a look at the financial condition in the United States. This chart represents the National Financial Conditions Index, NFCI, provided by the Federal Reserve Bank of Chicago. The NFCI is an index that comprehensively assesses the risk levels in the financial markets, credit conditions, and leverage situations. Red, risk. The risk in the financial markets. Blue, credit. Credit conditions, how easily businesses and consumers can obtain funding. Green, leverage situation, how much financial institutions utilize debt relative to their assets. The black line represents the overall NFCI. A positive value indicates increased financial instability. A negative value indicates that financial conditions are looser than average, and currently, it is well below zero. Currently, the U.S. financial market is considered stable, maintaining a recovery since the pandemic. Credit and leverage are balanced without significant issues, indicating a stable overall financial market. When the financial situation in the U.S. stabilizes, a lot of money will flow into the market. Where this money flows is important. If interest rates are low and the investment environment is favorable, people are likely to invest that money in assets like stocks or cryptocurrencies to make a profit. This means that liquidity is more likely to flow into the stock market or cryptocurrency market. Powell also mentioned in his speech on Monday that he plans to lower rates by an additional 0.75 basis points in November or December this year. This means that one of the two rate cuts must be 0.5 basis points. And if the government releases the funds it has accumulated along with the U.S. presidential election, it could lead to the much anticipated Santa rally for investors by year end. Given the importance of China's situation, let's take another look at it following our previous discussion. In the last video, I mentioned that China plans to inject 1 trillion yuan, approximately $137 billion, to stimulate the economy. We can see that there has been a significant difference between China's economic growth targets and actual growth rates over the past few years. The blue line represents actual growth, while the red line indicates the target, and since 2020, actual growth has often fallen short of the targets. This suggests that there is a high likelihood of even lower growth in 2024. Therefore, it is believed that economic stimulus measures will be necessary if the targeted growth rate is not achieved. The data on China's real estate sector also indicates that the Chinese economy is facing a crisis. As economic growth slows down, there is an increasing possibility of deflation, a decrease in prices. In 2022, the bankruptcy of China's largest real estate company, Evergrande, compounded the situation, leading to a disastrous decline in the real estate market. The Chinese government is introducing strong stimulus measures to tackle this situation. One of these is what I mentioned in a previous video about injecting money into the market through interest rate cuts. The chart you see shows the difference between the interest rate that the People's Bank of China offers to banks for one-year loans and the interest rate on one-year AAA rated negotiable certificates of deposit, NCD. The People's Bank of China has lowered the interest rate on medium-term lending facilities from 2.3% to 2%. This is the largest cut since banks began using monetary tools to guide market interest rates in 2016. This indicates that a significant amount of money could be injected into the market. Let's wrap up the video by looking at the on-chain data. Investors are not creating downward pressure by depositing Bitcoin into exchanges. At the end of a bull market and the later later stages of a bear market. The number of addresses depositing Bitcoin into exchanges tends to surge. However, in this current cycle, the number of addresses depositing Bitcoin into exchanges has not yet surged. This chart represents the price momentum of Bitcoin and indicates whether there is a possibility for the price to rise or fall. The chart is divided into three main components. The blue line represents the upward price momentum. When the value is above zero, it indicates that the price is moving positively, and when it is lower, it changes to red, indicating a negative movement. It had been in the red zone for several months, but now it has broken through zero and turned blue. The momentum indicator is shifting in a positive direction. The figures from institutions handling Bitcoin ETFs indicate that we are moving into a bullish market. When the blue line rises, it signifies that the funds are holding more Bitcoin. Since funds are a means for long-term investors to hold Bitcoin, an increase in this figure can be interpreted as a signal for long-term price appreciation. Historically, when the holdings of these funds increased, the price saw significant rises, and we are witnessing that again now. If the last phase was round 1, it seems that round 2 is approaching. This chart represents the investor tool indicator. The chart is set up with two key indicators. The red line represents the investor bottom 2-year moving average, indicating historical price lows for Bitcoin. When the price is below this line, it suggests extreme undervaluation, making it an excellent accumulation zone for long-term investors. The green line, known as the investor top, indicates the historical price peaks for Bitcoin. This is the value of the 2-year moving average multiplied by 5. Approaching or surpassing this line suggests that the market is overheating, indicating a potential overvaluation of Bitcoin. Therefore, this point may be a time to consider selling, but in this phase, we have quite a way to go before reaching that point. So even if the price dips and fluctuates, it would be wise to hold on until the price reaches the green line, at which point considering a sale would be advisable. I will summarize today's video. Although the employment indicators are still solid, they are continuously slowing down, so I believe the US will continue to lower interest rates. The entry of BNY Mellon, the largest bank in the US, into the crypto market could trigger traditional financial institutions, which have taken a conservative stance, to enter the market. If interest rates are lowered, I believe that the US financial market is in a very strong state and is well equipped to provide large-scale liquidity. Even if Bitcoin's price is pressed and fluctuates in the short term, most of the puzzles to move into a bull market are almost in place. I hope you won't be swayed by small fluctuations, just a matter of timing. I'll see you in the next video. Thank you.